the daily report, which you guys see me reviewing every week, selected portions of it. So page 1 is this one. It's this table of contents. And then I include a sniper trade of the day just as a sample of what right looks like to review patterns and to, just to keep that fresh in your mind. And then these pages that are in blue are the ones that are actionable signals. Actionable signals for different systems. You don't have to understand all of them. You should understand the ones that you want to trade and go to those. Like, I will give you some pictures of these market health checks. And that's just pictures of the S&P 500. This looks at that 150-day look back, the 30-day simplified sniper indicators, and then looking at the 30 minutes. So those are really just to help me understand what the S&P is doing on a long-term, mid-term, and short-term basis so that I get a feel for market location and conditions for the different kinds of trading that I do. Like when I'm thinking about the core, I'm really thinking about 150 days. And when I'm looking at swing, I'm really thinking about the 30 days or the 30-minute, and day trading, the 30-minute and the 10-day look back. So pages 3, 4, and 5 give me that. Dashboard 1 is summarizing the market conditions. That's really almost the same as page 1 of the weekly, because I use those indicators every day, starting at the top with the market. Then I do summaries on dashboards 2 and 3. I say the Dow 30, but it's really a modified Dow. I've replaced some of those 30 with some of the routine trading targets. Some of them are mid caps and like that. And they're not in the Dow. But I like having them in that category of individual companies that I like to trade. And then those two are going to summarize swing trade, day trade, intraday stats, some indexes and patterns and stuff like that. We'll see that in a minute. Then I look at the auto framer and the regression line fractal, and these are related to two different strategies. These are not systems, but they are strategies. So you need to understand that a system is a detailed specification that a robot could trade with absolute precision. A strategy is a looser form of tendencies where I'm doing some framing and interpretation, and there's multiple ways I can implement that, but I'm using trade framing in a particular way, a certain relaxed approach. A system can be very precise. A lot of times I will take a system and then start modifying it and add options, and it becomes a strategy. Sometimes the strategy gets codified in a particular way and can become a system. Like the ETF2 database and model supports a lot of different strategies. It also can be interpreted and traded specifically as a system with mechanical precision. But because I consider myself to be a mechanical trader with discretionary tendencies, I generally spend more of my time in the strategy area, allowing my trader discretion and flexibility to come to the front. Check or hold. So if I have systems and strategies, I also have techniques, and these turn out to be like little modules. Like the NDX is just an indicator that can be used to inform a strategy or to build a system. So techniques are like modules, like the no lose plus dinner for two, the NDX, the ATR percentage, the color coding, and then there's tips. These are just good things to know. Like in a bear market, every failure pattern of a swing is an instant short. So in bear markets, you can take a 5DD swing trade, and you can also, when it fails, you can take a 5DDF and a triple screen F and a 551WF and a channeling F. Failure patterns in bear markets dominate. Collapsing dragon. So that's just a tip. So the auto framer I will cover, and then you saw me sort of hint at the RLFF already. And then I look at the daily squeeze and RLFF candidates. Page 12 is a summary of the sniper concept. And then there's some Godzillas and then some stats on the tactical trading set. There's a table that shows the MACD 4 seasons, the multi-time frame index, and some frog statistics. So these are all little pieces and parts and builders of different systems and strategies. Those are all actionable and lead directly to trade frames or even mechanical rule sets. These down here, 19 through 30, tend to be background understandings about market conditions and symbol performance, looking at longer term nuance that can be used to build pieces and parts of systems, but give me the kind of broader market view to look at longer term trends and tendencies that don't lead directly to actionable signals. But most of the things that appear up in here used to be down in here, and then insights from here help me understand why those things work and where I can go for more information. So these are also, in a sense, part of the market mosaic that help me understand broad market and sector conditions. Check or hold. Okay, so that gives you the page 1 table of contents. Sniper trade of the day. That one and you've seen me cover that a lot. And then the 3 market health checks. This is all SPY on the 150, 30, and now the 30-minute and 10 days. Now, I want you to notice that this yellow zone right here marks off Thursday's, the high and the low and the current price where it closed. So it closed at the top of its range. And when I'm doing auto framing, the mechanical entry for those is always a breakout above today's high and with a initial stop at 5 cents below today's low. So this actually gives you something like a range risk or 1R of range risk for auto framing. Now, in general, the way I think about this is that this is the high as the bulls could push it, and that was as low as the bears could push it. So this is where the tug of war happened today. If it opens inside the yellow zone, I have no change in the strength of the bulls and bears until the bulls can push it higher than they pushed it yesterday. When I see price get higher than yesterday's high, then I know that there's new buyers coming in, adding their money, or new money coming in, maybe the same buyers but more money, and they're pushing that thing higher. That's an indication of increased buying pressure. So that is my automatic trend going, and I want to follow. By the same token, when I look back over here and I see the peak of the dragon and the peak of the RL10, that is as high statistically as they could get it before it failed. So if this breaks out from here and then breaks out higher than this, that's where I want to add second positions, because now I have evidence that the buyers are continuing to push it higher than they could before. This has everything to do with understanding trade location and the psychology of buyers and sellers based on past performance and key price levels. Check or hold. So the color codes help me understand the regions. Now the blue box gives me the 10-day high and low, and then this shaded blue gives me the 5-day, and this gives me the 1-day. So I have 1, 5, and 10. And I see that as scores of 0 to 100 on the 10-day. Here's the 0 and 100 on the 5-day. And here's 0 and 100 on the 1-day. So I am always looking at things in terms of that calibrated scale of 0 to 100. The multi-time frame NDX view. And then this is also the green zone, the yellow zone, and the red zone. In the red zone, I would like to be short collapsing dragon. In the green zone, I want to generally be long. In the yellow zone, I can only trade if I can see an intraday 1 unit of risk and 2 units of reward. So if this thing sold off, found support, and then moved a risk box off the bottom, I could trade that because there's 2 units of reward to the place where I'm not allowed to be surprised that it would fail, because that's where it failed yesterday. So if it's coming up here and I'm long and it starts to stall, that's the 2R battle drill. That is a technique. When you have refined your techniques, you now have a module that you can use in strategies or refine even further into precise rule sets for systems. So I could just invoke the procedure of the 2R battle drill and make that a formal part of a system, or just generally use that in a strategy. So techniques are your tools that can be applied to a lot of different projects. Check or hold. All right, so now we're looking at dashboard number 1. You will recognize this from the weekly. It's the same thing. Market classification, market location using the NDX, all of the little supplementals, the risk Z, piece of cake. So those are all the same, and I look at those every day. Now I add for the daily the gap statistic. And this is tricky. So I study the gaps of the last 30 days and the gaps of the last 200 days. You guys are just going to get the full Monty tonight. I'm going to record the entire darn thing and just plow all the way through it. So just hang in there. If it's too much, come back and listen to the recording, but I'm going to go all the way through it and finish this thing one time correctly, okay? With your permission. Now, the gap statistic is describing the recent behavior of the S&P from close to open. So here's what that means. So if I looked at yesterday, day -1, and it opened here and it sold off to there, and then it closed up to here, and then and this is where it closed, I could say that's the high and that's the low, and this was the open and that was the close. And then the market opens at that line. Let's draw it blue because I always draw it blue. And this is where it opens. So the gap would be the difference between where it closed and where it opened. And we can express that gap as a percentage of the closing price. And we want to do that so that we can be consistent in the relative size of the gap over many periods of time. Check or hold? Now, if the market closed here, and I draw this line, it can the gap can only do one of two things. It can be a gap up, or it can be a gap down. If it opens right where it closed, then we classify it as a gap up of value 0. So it can only be up or down. Check or hold? Now we're going to take a look at the follow-through over here on the right side. So if it sorry, let me draw that better. Now I'm over here looking at the open. If it opens here and I come over here to the close, it can only close higher or lower, and we think of that as the follow-through. In this case, the follow-through was up. In that case, the follow-through was down. If it closes exactly where it opens, then it was a up follow-through with a value of 0. So there's only two conditions for the follow-through. Check or hold? So now let's take a look at this table. The first thing it can do is gap down, and then follow through lower. So what does that look like? Well, here's where it closed, and here's where the open is. That means on the first category, it gapped down, and then over here at the close, it closed lower than it opened. Check or hold? So this was yesterday's close, and here's where it opened, and that's where it closed. So gap down and drop. The second thing it can do is gap down and reverse to close higher. So that looks like, I should have drawn that in red, it gaps down and closes lower. It could also gap down like it did, but then close higher. So that's category 2. Gap down and then reverse to close higher. Check or hold? The next thing it could do is it could gap up, meaning that it gaps up to here. But then it closes lower. But it may also have, in the final condition, gap up and then continues to gain higher. So those are the only 4 things that it can do. Everybody clear? So what we're going to do for the S&P is we're going to go back the last 30 days, and we're going to count the number of times that it gapped down and dropped. Well, in the last 30 days, it gapped down and then dropped 8 times, and the size of the average follow-through was minus 0.73%. Check or hold. And then 7 times it gapped down but closed higher for an average gain of 0.98. Now, here's how I use that as a guide. What that tells me is that exactly 50% of the time in the last 30 days it gapped down, and 50% of the time it gapped up. So which way is it going to gap tomorrow? It's a coin flip. But if it gaps down and then starts to reverse higher, that's actually a better trade than if it gaps down and then keeps failing. I actually like that. All right. Because remember, because it's moving almost half again as far to gain a 1%. And then 8 times it gapped up and reversed 0.63. And then 0.61. So that's a wash. That's just what it did in the last 30 days. In the last 200 days, slightly different numbers. 55% of the time it gapped down, 45% of the time it gapped up. The gap up and fail was better trade than the gap up and go, and the gap down and reverse, the morning hook, was the best trade in the last 200 days. So it closes, it gaps down, it sells off and starts to reverse. That's the best trade that there was in the last 200 days, says the gap statistic. Guess what happens? These percentages change every couple weeks, and the truth changes on what you should be doing about the size and magnitude of the gap and the directionality. So that's one thing to understand about the gap and the follow-through for the S&P. This one has everything to do with the size of the gaps in the S&P itself. And this goes back 200 days. And in the last 200 days, the largest upward gap was 3.72. The biggest adverse gap was 2.2. And a normal gap was plus or minus 0.81. Now, it turns out I include the average gap in there just to show you that going from close to open, sometimes it gaps up, sometimes it gaps down. When you just take the straight average, it all equals out, but you get some exceptional size gaps, and then a plus or minus 0.81 is a normal gap. Now, why do I care about that? It turns out that the direction of the gap does not predict whether it's going to go north or south. You can see that now. It's almost equally split about whether it gaps up or down. It's equally split about whether it continues higher or goes lower. But what is persistent is the idea that the larger the gap, a large gap predicts large follow-through. Why? Because a large gap means that there was a lot of news, and now some guys have to get out of that trade. Some people want to get into it and change hands. So the larger gap predicts that it's in play, and all other things being equal, if you want to maximize the size of the movement intraday, you want to be on the targets that move a lot. So the bigger the gap, the more you ought to be trading that particular target. You just don't know which direction. And sometimes you should fade, and sometimes it follows through. All you need to know is that if this is where it closed, and now in the S&P, if it's greater than 0.81 in either direction, percentage-wise, you should put a tight box, the minimum manageable risk box around the open, and if it continues up, take it long. If it starts to fail, fade it. And that's whether it's large up or large down. The bigger the gap, the bigger the follow through, the better the intraday trade. Greg asks, is there a slow change over time? Yeah, because on the 30-day, you're dropping 1 day and adding 1 day. But over the course of about 10 days, you can see significant changes in the follow-through percentages. And then that leads to it takes about a month of changing market conditions to really affect the 200-day gap stat. So I look at the fast gap and the slow gap in terms of directionality. And then this is the intraday moves of the S&P. This is 1 day over the last 200 days. The biggest single intraday move from high to low was 5.5%. The average move was 1.6, and the standard deviation was 0.8. So what constitutes an average move is, what do we say, was 1.6. Oops. Let me clean that up. So an average move is 1.6 plus or minus 0.8. So the range of normal is between 2.4 and 0.8. That's a normal-sized day in the S&P. But if it gets beyond 2.4, it went as high as 5.6. And the smallest day that we ever saw was 0.3. So this would, in retrospect, that would be a quiet day. This would be kind of a normal day. And anything beyond 2.4, it could go another 0.8, 0.8, 0.8, 0.8, 4 more standard deviations. That's the kind of day that is a range stat move. So you need to know that some days the S&P crushes it, and the day that it had a 5.6%, it also had a large gap. So that's what you can learn about the S&P from gaps. And because that drives the rest of the day for most of the things that we trade, I pay very close attention to the gap. And when the gap is indicated going to be large in the futures, I already know it's going to be a great trading day. Do large gaps beyond Z3 turn into the Anderson trade back to the regression line? Sometimes they do, but remember, in terms of the gap, if it was a big gap up, there is an equally likely probability that that thing just keeps going as compared to coming back. So the one that comes back is the Anderson regression line stretch because it spikes way up and then fails. But other times, like with a little frog box, this thing goes and it just keeps going. But the larger the gap, the more alert you should be to intraday trading opportunities. And you can know that by looking at the futures for those big broad indexes and determine, is this going to be probably a quiet day, a normal day, or a volatile day? If it looks like a big change in the overnight trading, and which drives the gap, it's going to be one of those days that I want to maximize my intraday trading. If it's a really quiet day, it might be a slow train, slowly building momentum, and maybe the news happens after the opening, like on a Fed day. It's normal for Fed days to have almost no gap, and then a little bit of trading that gets very, very quiet, and then big moves. And then the follow-through the next day is a big gap as people react to the changes in their postures based on what the Fed says. Okay? Now, the next section here is the channeling system and the overreaction. These are conservative, purely mechanical swing systems for the large indexes only if you are trading that formal system. It only uses these symbols. There are very simple rules. Like the channeling has two rules. These symbols have to be above their 200-day moving average, but they have to be oversold on percent R, and if you do, you buy it at the open. Done. And then you exit when the percent R goes after. So what are you doing? You're buying strength on a dip, and then you're betting that it's going to just follow through and resume. You buy it blind. That's purely mechanical. You can tweak that, but it's no longer the system. It's a different strategy. The overreaction looks for strength that has had a sudden, not a drift, but a magnitude of a move that moves it away from the 10-period moving average, and then you buy the resumption because it's probably an overreaction. That's what we call it, the overreaction system. I'm not going to cover those any further, except to say that they are high reliability systems, like anywhere from 0.65 to 0.8 on a given year for the successful trades. So I always look to see what are the big broad indexes doing mechanically. I use the daily pivots because I can use those for intraday trading in the futures or the indexes based on the way the pits describe pivot points, R1, 2, and 3, S1, 2, and 3 for resistance and support. These become key price levels for these big fat U.S. indexes. I'm not going to cover those tonight other than to say this is the daily computation for what those key price levels are. It never surprises me when there's a gap and it goes down and then starts to reverse, and then that becomes one of those support 1, 2, or 3, because that's where the futures guys are starting to hit the bid. And then it goes up into here, and it doesn't surprise me if that was one of the resistance levels. So you got to know your price points if you're trading big fat indexes. I like to just track the min pain and the max pain from the 10-day. So from the 10-day high, that thing will have sold off to today's close. I take that distance and I say that's the amount of pain from the 10-day high. And I take the amount of pain divided by price, and then I express that as a percentage. How far from the 10-day high has it fallen as a percentage of price? And then in the Dow 30 set, these are the ones that are the closest to their 10-day high. That's good. And these are the ones that are the furthest on a percentage basis from their 10-day high. What does that mean? That means it has fallen the furthest, but if it starts to reverse, it has the best chance to recover with a big move. But if it fails out of the yellow zone, then whatever caused it to fail, it might be leg 2. So this is a poor man's way of doing max pain range compression on the leading candidates based on relative trade location. Now the tactical summary. This is the same chart as we're going to see for the ETF, so I'm only going to explain it once. It's just a different symbol set. The first thing I look at is, was it a doji? Because all other things being equal, I like to see a doji, because that means that the yellow zone is small and that mechanical entries for any signal or any system are going to happen early. So a doji is always a sign to me that it is pausing, and now I'm going to have the smallest R against a potential long or short back to the 10-day high, for example, or to the previous support. So all other things being equal, I like dojis. So I define the doji as being less than 80% of the average range, so it's a small range, and that the open and the close are within close proximity to each other. That's what a doji looks like. The exact precise definition is not important. But I have that tuned based on if this was the high and that's 100, and this was the low and that's a 0, I want those to be within 20 index points, and I want the range to be small, and these all meet that criteria, so they are dojis. Any of these symbols that fires on the channeling system, now remember the channeling system dealt only with those 10 indexes, but the channeling strategy I can apply to other symbols as well. It just has not been back tested and doesn't have the same level of confidence. But it's a standard pattern of buying strength on a dip, and maybe it's a resumption. So I can frame that trade instead of just automatically buying it. Maybe I can estimate the reward to risk, or can wait to see it start moving in the morning, or I can wait for a mechanical entry. There's any number of ways you can convert a strategy into a rule set. But this one looks for the same setup criteria, and if any of those were channeling, in other words, were they above the 200-day moving average and oversold, then this would fire with a green light. The same thing with the overreaction long or overreaction short, because the overreaction can go both directions. The washout pattern, the 5-day down, the triple screen, the 551W, those are all mechanical signals from systems that we teach in the mechanical swing trading course. And if any of those signals fire, then you get a little green light, like I know that the 5DD fired for JP Morgan and for Tesla. Now these turn out to be strategies. Max pain range compression, and the auto framer. I love the auto framer because it tells me from a 10-day high and whatever today's range was from the close, it expresses the distance from the mechanical entry 5 cents above the high. It counts that as R and says how many daily ranges until the 10-day high is hit, and expresses that as a ratio. So Caterpillar is, if you took Caterpillar's range, there are 5 of those ranges back to the 10-day high, and that looks like an automatic easy swing trade frame for me. But because it's fallen so far from the 10-day high, that if it keeps failing through the low, I want to be short. And we actually have a strong swing trade on that one, and continuing to pound it. Now notice also, well, we're going to come over here to the right, but we're going to see that it is failing below its 10-day, 1-month, and 3-month look-back periods. So if I went back 10 days in Caterpillar on the 10-day NDX, that means from day -1 to -10, it scored -11, meaning that its low was below the previous 10-day low by 11 index points. And it's below its 1-month look-back period and 3-month look-back period. That's how bad Caterpillar is. That's how good Microsoft is. And so these little red and green signals occur when when price closes outside of those index look-back periods. And like a raccoon attracted to shiny things, those represent the exceptional information that tells me what to look for. How do I sort this? I sort this by alphabetical so that I can always find the signals that I want. What I look for are the auto framers and the exceptional information, and then the patterns, and then the symbols that are colored red were 1-day big percent losers, which I know because the 1-day performance percentages I look at the max, the min, and the ones that are exceptionally good get color-coded green, and that's why their ticker symbol is green. And this was terrible, red, and that's why his symbol is red. So in a nutshell, I can see exceptional information. I can see relative performance of the exceptional winners and losers for those look-back periods. I get some framing statistics in here about hybrid frogs, ATR percentages, the gain stat, the fail stats, all of those intraday performance measures that we use in the advanced day trading. I can get the all-important range stat. I can see the auto framer for swing auto framing. I can see what patterns are hit. And I can see if anything was a doji, and I can see the exceptional winners and losers each day. So there's probably 30 different actionable items and pieces of information inside here. And then when I want to do advanced intraday trading, these things like the gap stat, the gain stat, and the fail stat tell me how far those things have fallen. And I'm going to show you how there's one page for each one of those in the detailed pages of the report. So if you were going to specialize in Caterpillar or Microsoft, then you should really know what all those things are. Or when you're framing a trade for intraday trading, you better know what those numbers are, because you get an easy way to determine normal and abnormal behavior. I'll give you an example. The fail stat is crucial. That tells you how far, on average, over the last 30 days, from the open to what became the low of the day, how far was that? I don't care what the rest of the follow-through was, but from the open, how far did it fall to the low of the day? And it turns out that in, let me find one in here, Apple, on average, it fell $1.16. So what if, all other things being equal, I saw Apple had a big gap down and it sold off $1.16 and then found support near yesterday's low, and it started to make that hook and reverse? Guess what? I can put an MMRB on that with some confidence that I'm not allowed to be surprised if it starts to reverse after a fail stat. And then I have potential 10-to-1 trade if this thing moves a range stat. How far can it move on a range stat? $3.93. And then my MMRB is 1/10 of that, so I could use a 40-cent risk box. If it's moved 40 cents off the low of the day after falling a fail stat, I can just put that trade on and have a 10-to-1 frame to the upside. But if it turns around and fails below here, then it's already exceptionally weak, and I want to just stop and reverse, because it could be a massive move to the downside. Like, it's already moved $1.20 to here. It could move $3.90. That tells me it could move another $2.70 on a 40-cent risk. So there's a 7-to-1 on the downside. That's the best trade you ever saw in your life. The morning hook. That's advanced day trading. That goes beyond the sniper. That's why you might want to take that course. So the gain stat is from the open to the high of the day. It measures the same thing. How far up does it go before it hits the high of the day? And then the fade stat, you don't even see it on this one. That's how it goes from the high of the day to the close. So we can use all of those numbers to help us frame the intraday trades or swing trades with ATR percentage. We can look at the price changes over different time periods. The ones that are in the red are exceptionally weak compared to this peer group in each of these look-back periods. Look how good NVIDIA has been over 1 month, 3 month, and 6 month, but it's starting to cool off. But what's becoming exceptionally strong? Microsoft and Nucor, etc. So this little actionable dashboard there's enough ideas on there for 40 different trades a day on different time frames. You got mechanical swings, you have swing strategies, you have one-day winners and losers, you have auto framers, you have exceptional performers based on location, you have intraday framing statistics with a key and an index down here of how all these things are calculated and how we use them as a cheat sheet. Same thing for the ETFs. Look how bad marijuana has been. Oh, it's been getting slaughtered, but there was a one-day good move in it. But we have made so much money on the short side, I think it's not even funny. Lots of dojis, handful of auto framers. You read this chart exactly the same way. This one is the auto framer that computes the reward to risk ratio of all of these symbols, that combines the Dow 30 and the ETF 30 into a single best. These are all the ones that are better than 2 to 1 from the close, and then using the range risk to the 10-day high. If it's better than 2 to 1, it codes it as a winner here, and it gives you all of the framing data needed to do mechanical entry and exits. And then this tells you some more information about risk calculations, and this is the reference data that is used to compute these different ratios. This is a clever piece of information here on the risk calculations. If you use the range risk, then that means that's how big the range was, plus and then you add 5 cents on either end of that. But if you wanted to use a quarter of an ATR, that's how big it is. If you wanted to use a full ATR, that's how big an ATR is. What this little computation for my risk does is it finds the middle value. It's either going to recommend range risk, or if the range risk is bigger than an ATR, it says just use an ATR, and it uses my risk. See how it picked 516? In Home Depot, the range was $5.65, and that was bigger than one ATR. That means that was an exceptionally large range, and maybe you only want to use an ATR for your range. So it gives you different choices based on range risk compared to an ATR. Sometimes for intraday, you might want to just use a quarter of an ATR as an intraday range box, so it computes that for you. So it uses my risk to compute reward to risk back to the 10-day high, and it tells you what your mechanical entries and stops are, what the 10-day high is, what your reward to risk dollars are, and what the ratios are expressed in ATRs. So very handy for computing the auto framer. I used to do this because I was getting these mechanical signals, and then I wanted to compute the reward to risk, and then pick the ones that had the best reward to risk. And once I started doing this, I realized, I don't even need to have a specific pattern. Just based on trade location from price to 10-day high, and based on reward to risk, I could manage that trade simply because it was moving in that direction, and if it got to the 10-day high, I would have a good one. So it turns out that the auto framer became another mechanical swing trade system that did not require any particular pattern, simply trade location. That absolutely blew my mind, and that's my primary method of selecting swing trade candidates for the last 15 years. Accidental discovery. The daily squeezes now is looking at something else. This is taking a look at the size of today's range from high to low and comparing that to the average range. So if the average range is way up here, but today's range was a tiny little compression, this ratio tells you how many of today's ranges fit inside a range stat, which is the average range plus 1 SD. So if I get something that's better than 2, just by using the mechanical range, if it makes a range stat move, I'm going to get a huge one-day trade. So everything that is exceptionally compressed gets highlighted, and then I just simply show where is Tesla, and then where are my big fat indexes, so I know which indexes are very quiet. And I love it when the Dow and the Russell and the S&P are all exceptionally squeezed. That means the whole market has been compressed into a tight little coiled spring. And that means Monday, if that mechanical entry is hit, then that thing could really go with the smallest range risk possible. I really want to be a trader on Monday if it breaks out above the mechanical entries. That's how you do it. Opportunity trading. This one looks at the regression line fractal framework. I told you before, 3 hours ago, that the RL270 is the long-term buy and holders fair value. And that when the RL10 and the RL270 are together, the RL10 is the trader's price. When they are both at the same price level and they are overlapping, then both the long-term traders, the long-term buy and holders, and the short-term traders agree. The next thing that has to happen is that the traders are going to move it as far as they can. How far did they move it? Well, on a swing trade basis, what if we just took the ATR and said, how many ATR is it from the close back up to the long-term fair value? If this thing is exceptionally to the downside, that's good for a swing trade because these are on deep value. The traders pushed it all the way here. Now all the buyers want to come in and buy something quality on sale. What's the reward if I use 1 ATR of risk? Caterpillar is 3.5 ATRs below its long-term fair value. These are the top 5 best values in terms of the numbers of ATRs away from the RL270 as a long-term fair target. And in the ETF 100, the most liquid 100, these are the ones that are, look at, natural gas is 10 ATRs below its fair value. It's been murdered. Regional banks are 7.5 ATR below its long-term fair value. Let's look at that one, if we might. KRE. Well, I guess I want to use this one here. I can go to KRE. And then just go to the daily. So this is KRE on a daily. Here's the RL270 long-term fair value. It used to be back in here, but this has been enough of a sell-off that it has actually started to decay. But the 270 is here, and the 90 is here as an intermediate, and the 10 is right there. How far is it to here, you ask? I'll tell you, it's 7.4 ATRs. So how could I set that up as a swing trade? What if I played the PSAR flip just like this, and I bought it above here, and then put a 1 ATR trailing stop, 1 ATR right there? I would have 1, 2, 3, 4, 5, 6, 7 back to fair value. What if this thing failed? Well, the size of that move tells you that the size of the next move down is enormous. So that puts this in a critical state, and it's the best one in the whole stack of ETFs. How do I know that? Except for natural gas. Because it's 7.3. So these are the 5 best deep value plays in the ETFs, and those are for the symbols. And these are the ones that are the most overheated. It's the same thing, but in the other direction. The RL270 is here, but the trader's price is up here. And NVIDIA and Intel are 10 ATRs above their long-term fair value. Part of that is because they both got murdered in a sell-off. So I go to Intel. I think it's so far off the chart. Intel had been part of a long-term painful sell, but now it didn't fail, and it's starting to gain, and it's growing. It's now that many, it's 10 ATRs above its fair value, and this is just starting to turn. And guess what? This thing has a long way to go back to fair value, the previous heights. So what the regression line fractal framework does is it's a strategy that lets us find exceptionally interesting positions at the extreme, some that are beaten down for deep value and maybe further failure, deep value plays or continued failures, or overheated RS winners. They're either going to be continuation long side plays, or you better preserve in case that asymptotic move starts to collapse, like an Anderson regression line. And then this gives you the reward to risk on the basis of 1 ATR. Check or hold. I'm telling you right there, that's about a $10 million idea. Nobody else in the world looks at frames like that. And they cannot hide from the regression lines because they adapt so quickly. That's one of the best ideas you ever heard. Except for this one. The sniper, it looks at 3 look-back periods, 150, 30, and 10. It sets up the index for location between 100 and 0. It says there is oversold, overbought, and then right smack dab in the middle. And what I'm looking for on these different kinds of patterns is different configurations of setups. Like my favorite is the Godzilla. He is oversold on the 150 and oversold on the 30, and then he can be any position on the short-term 10-day, I don't care. The fact that he's here, plus his volatility is volatile. I'm sorry, I like the greater than not, I like him here or there is best. But I also want him to be very volatile. I actually don't mind if he's very quiet too. When you get the combination of exceptional location and volatility, you have in the sniper a compound critical state where the targets that hit those criteria are the most likely to make big, sudden, sharp moves the next day, which we can frame and crush with the minimum manageable risk box All you have to do is know the targets, and you know that they can move exceptionally, and then you follow either the SSC or the collapsing dragon or the Kata 2 all day and manage your risk with a minimum manageable risk box. And that's all you need to know. You don't have to know any of that other stuff, and just have that tight target box. When they emerge from the target box and start running, you shoot them. Sniper trading. That's the concept. This one now categorizes the Godzilla patterns, King of the Monsters, from our tactical symbol set, and then for the entire S&P 500, because these are so liquid. We've been crushing it with this. Using those same standard framing data, we can find strategies for which symbols have moved the greatest number of standard deviations on the 1 day, which ones are the most quiet, which ones are the most volatile on the 5 day. Easy. I use the TC2000 to give me my auto framers for those using TC2000. That has all of the charting packages and all of these frames all set up, so you get information independence from my daily report if you want to use that for the one-time payment for the administrative assistant that can scan 5,000 symbols and have all the intraday charting frames already set up for you. It's technique. The time savings alone are astonishing. 20 different lenses that we use in there. Griff Cooper and Phil have done the same thing for TC2000, or for Thinkorswim, I should say. Jeff Bocassio's done it for TradingView. So pick your broker. But this is how I do the auto framer in TC2000. This is what all the columns mean. I've already explained them on the Excel version. This one uses the concept of 4 seasons of MACD to find winter, spring, summer, and fall. And so it uses the 10 period and 30 period moving averages. And then when things go below the zero line, they're in the winter, and you want to be short. Until the spring, when you want to start incrementing into swing trades when you see the patterns. In the summer, it's time to grow and then harvest in the fall. This gives you, for the tactical symbol set of ETFs and the Dow symbols, which category that they are in, and then how far above the Red River they are, so you know if the move is exceptional. This also provides the sniper statistics for 150, 30-day, 10-day, 5-day volatility, 1-day volatility, range stat, and R10 for all of these same symbols if you want to use the sniper patterns on our tactical symbol set. This one is the multi-time frame NDX for 2-day, 10-day, 30-day, 90-day, 270-day look back using the color codes of breakouts, breakdowns for the Dow 30 targets. This gives you at a glance market conditions by leaders and losers. And this helps set me up as my little coyote for the master opportunist to find the things that are exceptionally good or bad. So that's a ready reference. And then finally, the frog list identifies the best trading vehicles for intraday trading. We're looking for a combination of reliably large range percentages, and the reliability comes from the frog quality number. It tells you how consistent those ranges have been. The higher the number, the more consistent. Better than 3 means very consistent. So you multiply the frog quality number by the range percentage. That gives you this ratio, and then we rank it by here. So the single best trader, day in and day out, is Tesla, marijuana, clean energy, Devon, Nvidia, and so on. And that's what you see me doing most of my sniper trades of the day on. Finding the reliable movers. Now, everything after this has to do with the detailed market mosaic. These are all based on the S&P 500, and it gives me additional insights into market conditions for turning points. Chart 1, the 30 days regression line. This is a moving average of that based on, what is that called? The polynomial moving average. Don't ask me for details. It just, it gives you sort of turning points smoothly. This one computes the slope of that regression line against 180 days of max min standard deviation. It gives you a z-score. That one is the most important indicator for me of market conditions. Here is the average and the zero line. When it gets more than one standard deviation below average and then crosses its 10 period and moves up, that's a turning point in the market. Look what happened here. This sell-off stopped, and this said it was supposed to fail further. It didn't. It then got better, and that's what price has done. So this does a great job of finding turning points. And if we look at the last 180 days, it takes this 30 days. That's the first. That's the last 30 days. This gives you the 180. Look how smooth and orderly those turning points at the extreme conditions are. That is a great way to help you understand turning points in market conditions from bearish to bullish. And you can trade that channel all day. This one measures the distance of price to the 200-day moving average, which helps us with our long-term market classification. So you get a sense of where the market's turning points and current conditions are. This one measures the volatility of the slope, that plus or minus one standard deviation over 10. Look, pre-COVID, it rarely got out of that plus or minus one. But since COVID, look how crazy this market has been. This is a completely different market condition that favors short-term swing trading and volatility trading. I can show you that mathematically, that the market is different. How different? Look at the difference. That's what statistics and math will do for you. This one shows you volatility measured by price standard deviation. This is a zoom in on the last 200 days of market oscillations. This has been great for swing trading. Our swing trading in February and March is off the chart goodness. And more goodness on the long side is coming. This one looks at the slope statistics, not just of the 30, but it also looks at the 10 and the 90 in context. And this one shows price within the river location. So this gives you short, medium, and long term. It's all spelled out here. These are detailed looks for market technicians, and I'm not going to spend a lot of time explaining those, other than to say this is statistics of a deep nature that are self-explanatory. You don't need these for actionable information. They are, I'm going to put them on, double secret probation or deep discussion for advanced traders. You just need to know that they're there. If you want to do follow-ups, we can explore them if you get into the advanced courses. But we're already 3 hours into this. You guys have done a great job hanging in there. These do not lead to actionable signals. They are simply supplemental information about markets and targets that are updated daily that give me insights, because I'm a fanatic for data and I want to know everything about my targets of interest. So when I come all the way back to page 1 of the daily report, just remember that your actionable information comes from these in blue, And you don't got to know all of them. Just pick and choose the ones you want. You might just like the snipers. You might like the auto framers. You might like the swing trade stuff that comes out of the tactical dashboards. Find the information you need for the trades you want to take and specialize in that. Just remember that this whole report consists of a lot of things on the salad bar, and you don't got to master all of them. You pick and choose the ones you need to make your detailed decisions. All right, so that's everything that I wanted to say. I appreciate you hanging in there. This was an opportunity to get it all done one time. I'll go back and have somebody put some timestamps on this thing as a service to the nation. But understand that that's the entire array of daily and weekend reports that supports all of our trading in every time dimension. So thank you so much for your kind patience and for putting up with that work. That's a pretty good 3-hour blast for you. Take good care. You guys have a great Easter, and we will see you in the chat room and in the nightly podcasts. Cheers. Let's see. Now, typically, I'm so brain dead, I have to remember how to turn this thing off. There we go. Take good care. Happy Easter.